There are not many industries that are as hated and misunderstood as investment banking, and it's easy to see why. Investment banks aren't banks, and they don't usually invest in anything either. So what the f do these guys actually do?
Unlike other firms in financial services, these Wall Street banks...
Goldman Sachs CEO David Solomon addressing concerns over his junior employees' workload.
Big talent war, there were big bonuses.
The issue of work-life balance is being brought up by first-year employees at Goldman Sachs.
The average salary for a first-year investment banking analyst at Goldman Sachs is $123,000 a year, and the median bonus received on top of that is $80,000 a year. An analyst performing at the top of their cohort can work their way up to associate, VP, and then managing director in around 10 years. MDs doing their job well can make a couple $1,000,000 a year from base plus bonus. A seven-figure salary before 30 is why so many people want to become investment bankers, even if they don't know what the job involves, and that can be a huge mistake. A survey of first-year Goldman Sachs analysts brought working conditions at these banks into the spotlight. The average analyst reported working 95 hours a week and getting less than 5 hours of sleep at night.
If your pain tolerance isn't high enough and you can't survive 100-hour work weeks, then perhaps you don't get to the next level of associate and so on, and hopefully climb that ladder.
Individuals reported showering once a week, too afraid to leave their desks because they would be shouted at by their superiors. This survey was completed by first-year analysts on first-year analysts. So as someone who has gone through this myself, I can tell you that the hours are real, but this report is a bit dramatic in my experience. So what tasks are these smelly analysts completing in their 95-hour weeks? The role of an investment bank is to link up investors and companies seeking their investment. The name investment bank makes a lot more sense when you think of a bank as a middleman. The word bank comes from the old Italian word banco, which means bench, like the bench that merchants sat on in market squares. A blood bank takes blood from donors and gives it to people who are sick and injured. A food bank takes food from donors and gives it to the hungry, and a money bank takes money from depositors and gives it to borrowers. An investment bank is just a middleman between investors and investment opportunities. To make matters more confusing, some of the biggest investment banks like Goldman have all diversified just beyond investment banking services.
I'm sorry, I don't understand.
Goldman now has 4 primary divisions. It has a property asset management division where the bank uses its own money to invest in the markets like a hedge fund. Its second division is regular investing and lending like any normal bank, further adding to the confusion between a bank and an investment bank. Its third division is institutional financial services. These guys provide coverage to investment funds with margin loans and trade executions. You can think of this like a Robinhood account for the biggest investors in the world. If you have ever watched the show Industry, institutional financial services is what most of the plot is focused around, not investment banking. To a layman, these 3 divisions might all look like different roles for investment bankers, but they aren't. Goldman's 4th division is just for investment banking that is kept totally separate from the rest of the bank's operations. There are also smaller firms in the industry, often called bespoke or boutique firms, that just do investment banking.
They have significantly leaner operations. That means they don't have consumer arms, it's unlikely they have robust wealth management arms, and they don't do any lending.
But alright, what does that actually involve? The actual tasks completed by the people working in the investment banking divisions of banks like Goldman or a boutique investment bank are a lot less sexy than Hollywood would have you believe. It's a lot more Excel and PowerPoint than 6-screen Bloomberg terminals and high-octane sales calls.
It's my own fault for using PowerPoint. PowerPoint is boring.
An investment banker is all about putting deals together, a lot like a real estate agent, but for companies instead of condos. The first step in putting a deal together is finding a client. Most of the time, the clients I worked with were investors or founders looking to sell their company or equity. This is called a sell-side engagement. We'd create lists of potential buyers of their company when pitching to represent them on a sale. These buyers fall into 2 categories: strategic buyers and financial buyers. Financial buyers are just looking for a good return. These clients will be private equity funds, hedge funds, or family offices that want exposure to a company that is not publicly listed. Strategic buyers are other companies that want to buy a competitor or a company above them or below them in a supply chain. Sometimes we were hired by a company to help buy another company in a strategic acquisition. This is called a buy-side engagement. One of the buy-side deals I worked on in my time was helping a publicly traded company acquire another private company that doubled their size.
Well, that's very interesting.
The final type of deal I worked on are strategic advisory deals, where an investment banker will evaluate a company to help them achieve strategic goals. One client that I dealt with wanted to sell $200 million worth of equity in his company to invest more broadly. My team was able to conduct strategic analysis and found that instead of selling his shares, the company could get a loan, pay it out through a dividend, and get his $200 million without selling his company. The company itself would then pay down the loan. This is called a dividend recapitalization. As an analyst or an associate, you will have very little to do with step 1, which is sourcing these deals anyway. If you are lucky, you might be invited to a conference or networking event by your MD or VP, who are the senior employees responsible for securing the business. For at least your first 5 years in the job, your work will really start at step 2. So it's time to learn how money works to find out what you would actually do if you became an investment banker and you were just handed your first deal to work on. Investment banking clients will always field offers from multiple firms to see who they think will get them the best price for their business. Once an MD has made contact with a potential client through their social or professional network, they will try to convince the client's management team to hand over their financials so that they can work on a pitch deck. This is when the associates and analysts will get to work. A pitch deck is a 20 to 30 page PowerPoint talking about how much the investment banking team knows about the company and its industry. A pitch deck will also include information about the team at the investment bank that will be handling the potential deal, how long they think it will take, who the potential buyers would be, and most importantly for the client, how much they think they can get for the company based on market analysis and the company's provided financials. A lot of time is spent making pitch decks that are rejected by a client that decides to go with another investment bank or not proceed at all.
I'm so tired!
If your team does win the pitch, then work starts on building out the marketing materials for the company to give to potential buyers or investors called a SIP, or confidential investment presentation. At this point in the process, the company will open up almost all of their information to the banking team to put together this packet. The final document will be about 50 to 130 pages in length and will contain a story about the company, what they are trying to do alongside the hard data like organizational structures, products, patents, financials, locations, and market research. All of this information goes into a data room that is constantly updated during the sale process. In the old days, this would be an actual secure room at the investment bank filled with boxes of documents. Now, banks receive and store documents virtually on programs like DataSite and Intralinks, which are like extremely secure and expensive alternatives to Google Drive or Dropbox. Another important piece of information that will be included in the confidential information presentation is the reason why the company is raising money. Companies can raise money for 2 reasons. Reason 1 is to invest into the company and expand operations. Bankers will call this seeking growth equity. To achieve this, the company will issue new shares and let the investment bankers sell them to qualified purchasers. Creating more shares dilutes the ownership stake of existing investors in the business, so it's important to them that the money is used to make the business more valuable than the amount of their shares were diluted by. If someone went from owning 10% of the company to 5% of the company after an equity funding round that doubled the number of shares, then the business needs to at least double in value for them to be happy with that result. Reason number 2 that companies raise money is to pay out existing shareholders. Bankers call this a buyout or secondary offering. This one is more straightforward. If a founder or early stage investor wants to cash out of a company they have built up, they will sell the shares to a new investor that wants to buy the company as a long-term hold or as a strategic investment, like how Google bought YouTube. No new shares are created, usually, and the money raised doesn't go to the business, it goes to the people selling their shares. The reason that the company is raising capital and everything else that the investment team gathers at this stage of the process is highly sensitive and potentially damaging if it falls into the wrong hands. Part of the job of a good investment banking team is to make sure that the confidential information presentation is shown to only those that have the highest probability of making a competitive offer. Putting together a SIP takes a long time and is incredibly high-pressure work. The information presented in these reports make or break billion-dollar deals, and if something is inaccurate, the investment bank could be liable for the damages caused by the reported inaccuracy. An investment banking team on a deal is usually made up of 1 MD, 1 VP, 1 associate, and 1 analyst. Exceptionally large or complicated deals can have multiple associates and analysts, but clients and bank management prefer fewer points of contact, and deals just operate better when there are less people doing the same thing. Once the team has finished producing the SIP and management is satisfied that there is not incongruent information, it is distributed to the buyers that the banking team and the client have agreed on. There are usually 80+ buyers on this list, and the team's job then becomes fielding calls from these buyers to clear up details about the deal. These calls are stressful because you are talking to people that expect you to have perfect answers to hard questions about 130-page technical documents on the spot. Oh, and your MD or VP is usually on the call as well. You also have to sell the client's company without saying anything misleading that could be used to sue the investment bank or later damage their reputation. The first stage marketing campaign for a deal can take up to 3 months, and during that time, the investment banking team will whittle the list of potential buyers down to 20 or less. From those 20 buyers, a good result is having 5 or more % further interest. At that point, they will be given further access to the data room and send out teams to meet management and tour facilities. From those 5, usually 3 will provide a letter of intent, or LOI, with an offer outlining the basic terms of the deal and the price that they will pay. If the client accepts the buyer's offer, the deal then moves forward to due diligence. During the due diligence phase, the investment banking team will work with the client's lawyers and the buyer's lawyers, as well as a variety of other third-party providers to go through a checklist of common problems and regular things that a business needs to have. For example, accounting firms will come in and review the financial statements to make sure that they are in line with what the company provided. The buyers and their teams will look at personnel charts, existing loans and liens, tax documents, and any ongoing legal problems. If they find any problems, the investment bankers need to be able to provide a solution quickly or risk losing the deal. If due diligence goes well, the buyer will then draft a purchase agreement using the initial letter of intent as a guide. The purchase agreement document is normally 60 pages long and contains a long list of terms and conditions, as well as a variety of other things like non-competes. These terms usually take a month to debate to work out, but once everybody is happy, a date is set for the deal to close and the money to be wired. Only at this point does the investment bank get paid their fee by the seller. The team will also help the buyer with mundane tasks like handing over the keys and arranging account access in the case of an acquisition. The new buyer needs to ensure that the staff is still getting paid and the business still open the next day, so the banking team needs to make sure this is all taken care of. This whole process from beginning to end can take half a year, and any little problem along the way can put an end to the whole deal. The clients selling their company have often not done anything like it before and will be very nervous the entire way. They will also expect someone from the team to be available at any hour of the day, as will potential buyers once they get involved. One wrong piece of information and thousands of hours of phone calls and hundreds of pages of documents can end your career. And if all of this wasn't stressful enough, an investment banking analyst is typically working on 4 to 6 deals at a time. Analysts that last past their first year are not partying or doing any of the other crazy stuff you see on TV. They are spending their time working or catching up on sleep and not much else. It's a grind that nobody can do for long. Most firms have an up or out recruitment policy where if you aren't promoted to associate within 2 to 3 years, you are fired, and the same with associate to VP within 5 years. The work of MDs and VPs is much more about finding business at networking events and engaging potential clients. The workload is much less intense and the pay is better, but some of these bankers spend a lot of their salary on maintaining multiple country club memberships just to get access to clients. Most investment banking analysts don't stay at investment banks. They get 2 to 5 years of experience working on deals and then transition into senior company management or private equity. Private equity has minted more global billionaires than oil and technology. It's a $4.7 trillion global business that, according to some outlets, has crushed your ability to buy a house and your chance to relive your childhood at Toys R Us. Private equity is simultaneously the ultimate career goal of every insufferable business bro and the cause of all the world's problems. But what the fuck do these people actually do?
Looks like this Hillpath Capital, which is a private equity firm, has purchased the outstanding shares of SeaWorld, and they intend on dismantling it and liquidating the company.
Private equity firms have been acquiring physicians' practices and medical operations at an increasing rate over the last decade.
Private equity is nothing more than any investment company that invests into assets that are not listed on public markets. The variety of private equity companies is enormous. Some private equity firms will invest in very early startups and give them money to grow their business and acquire new customers. These firms tend to go by the name venture capital, but that's still a type of private equity. Other private equity companies focus on buying alternative assets like airports, toll roads, intellectual property rights, and carbon credits. These firms offer liquidity to asset holders that would find it almost impossible to sell what they own without their services. You can't put your North Dakota drilling rights on Facebook Marketplace and expect to find a buyer. If something is worth money, there will be a private equity firm that will try and make a deal out of it. There are even private equity firms that are called a fund of funds, which, you guessed it, raises money to invest into other private equity funds. But when you hear politicians, journalists, and angry people online talking about private equity, they are normally talking about the buyout funds. If you can start and run a successful buyout fund, there is a good chance you will become a billionaire, because these firms are fine-tuned to make the most amount of money possible from buying entire companies. So if you wake up one day and decide to start a private equity firm specializing in corporate buyouts, here is what you will actually need to do in 3 easy steps. Step number 1 is, before you even think about going out to find your first investor or acquisition opportunity, is to get your corporate structure right. As a savvy private equity fund manager, your firm's legal setup is key. It's complicated by design, enabling you to minimize personal risk, maximize personal gains, and navigate complex financial regulations effectively. Your strategic move is to form a Delaware limited partnership where you'll be the general partner. The Delaware limited partnership is popular in private equity due to its legal benefits and operational flexibility. Here, you'll have the power to make critical investment decisions and manage day-to-day operations. A crucial element of this setup is the Limited Partner Agreement, or LPA. The LPA is a contract that outlines the terms between you, the general partner, and your limited partners, typically your investors. The LPA details everything from investment strategies to distribution of profits and loss allocations. It's the rulebook that governs the partnership, ensuring clarity and structure in the relationship between you and your investors. As the general partner, the LPA empowers you to steer the fund's investments, while outlining your responsibilities and the scope of your authority, balancing control with accountability. This structure, with its well-defined LPA, provides a stable framework for managing the fund, offering protections for both general and limited partners. If you have too much control, nobody will want to invest their money into your fund. And if you don't have enough control, then you won't be able to run your fund effectively. In the movie The Big Short, Michael Burry's character, played by Christian Bale, gets into an argument with one of his biggest investors who questions when other investors in the fund would be eligible to pull their money out.
My God, Mike.
Burry had made a very risky investment at this point in the movie that most of his investors didn't agree with. So if they could pull their money out, they probably would. But Burry's firm had rules about withdrawal eligibility written into a mandate, so they were stuck until Burry's investment paid off. Had they been able to pull their money out early, Burry would have had to close his positions and everybody in the fund would have missed out on one of the greatest investment opportunities ever. So this structure is essential to running your private equity fund effectively, but you're not done yet. You will also want to add a management company that is technically separate from the firm, but can give advice to the fund and the acquired companies. This is the part of the business that is full of the Harvard MBA analysts that you will need to pay $250,000 a year before bonuses, because they are the ones doing the math and due diligence on whether a company is a good investment or a bad one. While you're at it, you'll want to make yourself or a trusted business partner the chairman and CEO. Once you have this structure in place, it's finally ready to start schmoozing investors and finding beloved companies to drive into bankruptcy. So it's time to learn how money works to find out what the fuck private equity firms actually do. All you are really as a private equity general partner is a middleman between investors and good investments. So the second step is the simplest part, but also the hardest part. As the head of a private equity firm, you will be taking money from investors and using it to make investments into private companies. Those investors can make the same investments by themselves, so you need to try hard to convince them that their money is better with you, because you can make them better returns even after taking out your fees. Those fees are normally a 2 and 20 structure. Your firm will get 2% of all assets you have under management every year. This 2% is used to pay the salaries of the expensive Harvard MBAs working in your management company here. So once they have been paid, there won't be much left over for you. But that's what the 20% is for. 20% of all returns over a pre-agreed upon rate, called the hurdle, will be paid to you as an additional bonus. If you agree with your investors on an annual hurdle of 10% per annum, but your firm actually delivers 20% returns, you get to keep 20% of those additional returns for yourself as the firm's general partner. So there are some big incentives for you to make some big returns. You also have an incentive to manage as much money as you can because it's better to get 20% of a bigger pie overall. So one of your most important jobs is just getting people to invest with you. The first step in raising money from investors is that you will need to put some of your own money into the fund. If you aren't already a billionaire, your own money won't be enough to start acquiring whole companies. But this still does two very important things. The first thing is that it shows other investors that you are willing to put your money where your mouth is, and that you will take good care of the fund because it's your money at stake too. The second thing putting your own money into the fund does is create an exciting little tax loophole, which means you are going to pay a lower tax rate than most Americans, but you will see how later. Once you have put your own money in, you need to convince other people to trust you with their money, which is why it's normally a good idea to start a private equity fund after you already have industry connections and experience. If you don't have any of those connections just yet, don't worry. Some investors will also give you money if you have a lot of experience in a particular industry. So let's say you have owned and managed hotel chains before. You can create a private equity company that will just invest in hotels and other hospitality businesses. The number one best way to attract more investors is to generate consistently high returns. Do this for long enough and you might even have so many investors that want to give you their money that you will have to start turning them away. But for now, you will have to start small with your first acquisition. Your team of analysts at your management company will work with investment bankers who act like realtors for people looking to sell their companies. Your analysts are going to be looking for companies that generate profit with good cash flow in a stable industry with improvements that can be made by your private equity firm to increase profitability. Since you have told your investors that your skills are in managing hotels, your team will also need to look for deals that are in the hospitality industry. Buying a pharmaceutical company could violate the investment terms of your limited partner agreement, and you could get sued by your investors. If you spent your entire career managing hotels, you won't know shit about running a pharmaceutical company. They also need to work with investment bankers to find companies that want to sell at a decent price. Once a business is found, the private equity team will work with the investment bankers to draft an indication of interest and conduct due diligence on buying the company. The private equity team will also start talking to other investment bankers and private lenders to try and take out a loan to finance the deal. If your firm was only able to raise a pitiful $100 million from investors and the company you want to acquire is also worth $100 million, you are risking your entire firm on one bet. What you need to do instead is show a bank that the company you want to acquire has stable profits and good operating cash flow so that you can get a loan for $90 million to finance the deal. You can then use $10 million of your own money to perform a leveraged buyout. If you have only used $10 million, you can also do these 10 more times before you have deployed all of your money. The companies you acquire are called portfolio companies, and your job now is to get as much money as possible out of them for your investors. Private equity firms have a bad reputation for gutting companies, laying off staff, and saddling them with tons of debt. And that's because they do this a lot. Since you own the portfolio companies, you can tell their CEOs what to do. And if they don't listen, you can just appoint your own CEOs that will do exactly what you and your management team tell them to do. There are a few strategies that private equity managers such as yourself like to employ to increase the returns of their portfolio companies. One strategy is consolidating the operations of all the companies in the firm. Since you are investing in hotels, you could merge the booking, housekeeping, staff administration, rewards points, and contracting all under one entity to save on overhead and offer a better overall product to customers. But if that's too creative, then you can always use your team of analysts to find the areas of the business to cut costs like employee headcount, employee benefits, and employee training. But you don't have to be creative. You don't even need to cut costs. You can just use the company's profits to pay down the $90 million in debt, and then sell the company even if you don't grow it. It's kind of like buying a house and having a renter pay down your mortgage for you. This kind of Ivy League business advice doesn't come for free. Even though the management fee is considerably less than what you can get if you get a return on your investment, it's still a lot of money once you have over $1 billion worth of companies under management in your portfolio. Which brings us to the third and most important step of this whole operation: getting paid. By cutting expenses and improving business operations, your portfolio of companies should now hopefully be worth more than what you paid for them. So now you need to turn those paper gains into cold hard cash. The easiest way to do this is to sell the companies at a profit to a buyer. You can call up another investment bank and they will give you 3 options to sell your companies. The first option is you could take your companies public through a SPAC or IPO and sell them to the general public. The second option is to sell them to a strategic buyer, like an even bigger hotel chain that wants to acquire your portfolio through an acquisition. And the third option is you could sell it to another investor like another private equity fund, or a family office that just wants to continue growing it. There's one other important point worth mentioning. Since the firm operates as a partnership, and you as a general partner, and considering you're investing your own capital into the partnership, profits can be distributed as capital gains instead of income. Long-term capital gains is taxed at a maximum rate of 20% in America, which is a lot less than you would pay on millions of dollars in income any other way. This is called the carried interest loophole, but it has nothing to do with interest rates at all. The interest actually refers to the vested interest you have in the fund that you manage. That doesn't mean you can ignore interest rates though. As a private equity manager, you are going to take loans out to acquire new companies and to cash out of your positions, so the whole operation is very sensitive to interest rate changes. The stress of private equity is actually one of the reasons that we are currently in the midst of a corporate bankruptcy boom. The rapid growth of private equity has been blamed for pretty much every problem in America today, from mass layoffs to unaffordable homes. Some of this hate is totally justified, and some of it is just coming from second-generation Wharton grads who didn't land a summer internship at Blackstone. Whatever your reason is for hating private equity, you will be happy to know that after a meteoric rise, the whole model that this industry was based on is now facing a wild collapse.
And I really do think that when you have a group sitting as a state pension fund Warren, all they're doing is lying a little bit to make the money come in. Yeah, well, that sums it up.
That's because that borrowed money becomes the responsibility of the company itself,
private equity
not the
is
private
just
equity.
among the most malevolent sources in American economic life and global economic life.
Private equity is very simply any investment into assets not listed on public markets. There are hundreds of thousands of highly profitable and promising businesses in America and millions around the world that you would never be able to buy using Robinhood and some pocket money. Private companies are not listed on public exchanges and don't have the same reporting requirements, so it can be extremely difficult and time-consuming for investors to get a good idea if a business is worth buying and how much it would be worth if it is. This is where private equity firms stepped in as middlemen to offer rich investors access to this untapped market. If you were a billionaire or the manager of a pension fund, their pitch to you was simple. They could give you a higher average investment return than you could get in the boring old stock market. Your returns would be less volatile, and your money would be safer from market crashes. They could do this because they employed a crack team of the best analysts in the world to do all the hard work of finding and buying a private company or alternative assets on your behalf, and extracting as much money as physically possible out of it. Sounds too good to be true, right? Well, it is. Private equity has pushed its business model too far, and now it has trillions of dollars worth of assets that nobody wants. Which sounds like a good thing for regular people who have been the victim of the layoffs and cost-cutting that private equity has become famous for. Right? Wrong. There are 4 reasons why private equity is failing, and 4 reasons why all of us are going to be the ones paying for it. The first reason is that the returns they promised weren't as great as they actually looked. Schrodinger's cat is a thought experiment whereby you put a cat in a box with a poison vial that has a 50% chance to burst and a 50% chance to do nothing. Unless you open the box to see what happened to the cat, there is an equal chance of it being both alive and dead. Physicists use this to describe quantum mechanics, but private equity managers have used it to raise trillions of dollars using one simple trick. My friend Ben Felix, a professional portfolio manager and no-nonsense finance creator, first brought these problems to my attention in a post on Twitter, or X. You should definitely give him a follow if you aren't already subscribed. The value of the private companies and alternative assets that private equity firms built their portfolios around are hard to determine, even by company insiders with full access to their financial information. An unlisted private company doesn't have its stock price instantaneously updated like public companies do, which makes their shares harder to buy, harder to sell, and harder to assign a value to. In the past, investors expected a premium on their returns for compensation for this illiquidity. If you are a rich investor that suddenly needs money to cover an unexpected expense, shares in a public company or listed bonds are much easier to sell than almost any other asset. Liquidating a large number of shares in a private company or selling alternative assets like art, real estate, or patents takes at least a week to find a buyer, draft paperwork, and settle on a deal. And that's the absolute minimum. All of these assets also need someone like a realtor, auction house, or investment banking team to handle the sale, and they are all going to take a cut of the proceeds, which could eat into your returns. For this reason, more liquid assets that are easier and faster to sell at a well-known fair market price are just better. And the only reason why you would invest in less liquid assets is because they could offer higher returns for less risk. Private equity firms have changed this though, by taking advantage of their assets' biggest weakness and using it as a marketing tool. If they never sell the assets they hold and they never release financial statements, nobody has any idea how much their portfolio is worth. So they can just say a higher number every year, and as long as it doesn't get too ridiculous, nobody can call them out. NCAP, a large private equity firm, found itself in a controversy for exactly this, specifically with its investment in Southland Royalty, an oil and gas company. They formed Southland with over a $1.1 billion investment, contributing 80% of the capital, or $880 million, with other investors making up the rest. With their newly formed company, they acquired oil and gas fields around the US, including in the San Juan Basin in New Mexico and the Green River Basin in Wyoming, as well as purchasing 313,000 acres from another oil company. When NCAP set up Southland in 2015, it was hoping for a recovery in oil prices from a drop the year before. In June 2014, it was almost at $100 a barrel, but by the same time in 2015, it hit $55 a barrel. The problem is that oil prices didn't reach those prices again, and their new oil fields didn't produce nearly as much as they wanted. Fast forward to September of 2019, and they still valued Southland close to the same amount as their original investment. But 2 months later, they marked it down to $0 and filed for bankruptcy. When private equity firms represent the fair value of their companies accurately on their books, it's called marking to market. And since they need to compete with other private equity firms to raise money from investors for their next fund, they're not always going to be honest about their underperformers if they don't have to. Private equity managers could reinforce this idea by only selling their highest performing assets, furthering the illusion that everything in the portfolio was doing equally well. The very fact that these assets don't have instantly updated price information actually made them even more attractive with certain fund managers, because it lets them claim to their own investors that their money was growing steadily even during turbulent markets. For a while, this was true. After all, something is worth whatever a buyer will pay for it. But now, the investing public has realized that private equity firms are holding onto a lot of garbage that is going to be very hard to sell. All investment carries risk, and if this were just a story about financial managers delivering bad returns to rich investors after making big promises, it wouldn't need its own video. But a lot of private equity money is your money. And if this convenient lie unravels, it's not going to be the private equity partners losing their jobs. Private equity used to be an elite investing strategy only open to ultra-wealthy, sophisticated investors. And back then, it did deliver returns above the market. Warren Buffett's Berkshire Hathaway can attribute a lot of its early success to operating like a private equity firm, with famous investments like the Nebraska Furniture Mart and Heinz being private equity acquisitions. Investors saw the potential of private equity, and now it's gone mainstream. According to data from Morgan Stanley and published by the Financial Times, the assets under management in private equity have grown by 1,400% since the year 2000. Private equity strategies like growth equity have grown even faster. There is now 10,000% more capital in this space than there was just 24 years ago. And that alone is the second reason why the golden age of private equity is over. Charts that look like this in finance are notoriously always very sustainable, safe long-term plays that never end up collapsing aggressively. For legal reasons, that was sarcasm before you load up on Blackstone call options. Obviously, this can't go on forever, and already private equity's biggest threat has become private equity itself. If you're the only person in town buying real estate and there are a lot of renters looking for a place to live, you can pay whatever you want for a house because sellers have nobody to sell to but you. And you can charge whatever you want in rent because renters have nobody to rent from but you. Your returns from this kind of market should be extremely strong. For a long time, this is how private equity made their money. There weren't many firms buying private companies, so anybody that wanted to sell their business had to basically accept what these new firms were willing to pay. As more firms moved into the space and raised more money though, there was more competition to purchase these businesses. If you are a private equity manager and you can buy a business generating an EBITDA of $500,000 a year for $1.5 million using all debt, you will pay down the loan in a little over 3 years, and then you can sell the company for the same price, profiting $1.5 million. If you get into a bidding war with another private equity firm though, and the acquisition price becomes $5 million, then you are no longer even beating regular market returns. Now, this simply won't do, because if you can't beat the market, your investors will withdraw their money and you will miss out on your multi-million-dollar bonuses. So, you need a way to keep people invested, which is the third reason why private equity is struggling. Private equity managers get most of their money from delivering investment returns in excess of broad market performance. But data from Cambridge Associates, Capital IQ, and Bloomberg shows that the competition for buying companies has pushed valuations up. And using EBITDA over EV, a measure to determine returns, the average private equity fund underperforms the S&P 500 before fees. This was also shared by Ben, whose literal job it is to pick good investments for his clients. To try and maintain their relevance, private equity managers have resorted to leveraging up their business as much as possible, and cutting expenses wherever they can to increase their earnings. The most popular way to do this is with layoffs. A report by the Private Equity Stakeholder Project found average job losses of 4.4% in the 2 years after an acquisition by a private equity company. That doesn't sound too bad until you remember that most companies add employees over time, and this study was conducted during a period when unemployment as a whole fell by 4.5% nationwide. Cost-cutting has also resulted in businesses offering worse quality service to their customers. This is bad when they buy your favorite fast food franchise and cut the quality of ingredients in your Whopper. But private equity companies have even cut costs in businesses like nursing homes, preschools, hospitals, and prisons. According to studies from the National Bureau of Economic Research, as well as reports from The Atlantic, The New York Times, and Bloomberg, the endless push to lower expenses and maintain margins has been responsible for tens of thousands of premature deaths in some of the country's most vulnerable people. Private equity managers may be willing to do this to maintain their margins and keep their carried interest, But now, the whole industry has become so large that it's attracting the attention of regulators who are cracking down hard on these investors. At the end of last year, the Senate Budget Committee announced a bipartisan investigation into private equity ownership of hospitals, and simultaneously, the White House announced a crackdown on anti-competitive practices in the space. Congress is also pushing for a new bill that would limit tax breaks for corporate investors buying single-family homes. Currently, they can claim interest and depreciation as tax write-offs, which is making family homes one of the most attractive asset classes for investment funds that have grown too large to acquire more private businesses. 20 years ago, private equity was a niche investment strategy that nobody heard of, but its rapid growth and high returns got the attention of big investors who ruined a good thing by taking it too far. Now it's got the attention of young people who can't afford a home, elderly people who can't afford care, and politicians who can't afford to not look like they are doing something to fix this problem. A good CEO can build an average company into a billion-dollar success, and a bad CEO can destroy even a strong company in less than a year. With so much on the line, shareholders happily pay these privileged men and women millions of dollars a year for their services. But they are still just employees. They come to work every day and go home like everyone else. So what the f do these people actually do all day?
Musk has officially rebranded the company as X. He wants the app to be central to everyday life, with a hand in everything from communications to finance to gaming.
And ultimately, absolutely, I should have been on top of this, and I feel really, really bad and regretful that I wasn't.
So today, I'm excited to announce an entirely new AR platform with a revolutionary new product.
The real answer to what a CEO actually does is whatever they want. Within the company, they are only answerable to the board of directors, and the only power that board of directors has over them is to decide their compensation package or to fire them. The board of directors themselves are representatives of the company's shareholders, and in a lot of small companies, the biggest shareholders and the chairman of the board is also the CEO. So the board can't do anything apart from give advice and hope the CEO listens to it. That's only for small companies though. It is incredibly rare for the CEOs of public companies to have this much power. In fact, there is only one company in the S&P 500 where the CEO cannot be voted out by the board, and that's Meta's Mark Zuckerberg, since he owns a majority of a special type of share in the company. For every other CEO, their only real job is to not get fired by the board. The best way to do that is to keep the board that represents the shareholders happy by delivering strong business performance. Make Green Line go up is a simple objective, but it still doesn't answer what they actually do all day, since that goal can be achieved in so many ways. But I have to make this video before good work makes a funnier, better version of it. Again. So let's imagine that you wake up one day in the body of a random Fortune 500 CEO, and you need to make it through the day without being found out. Here are the things that only a CEO can do from the moment that you walk into the office until the moment you leave, probably quite late at night. The first task that only a CEO is allowed to perform in a large company is to choose the direction the company will take. As CEO, only you can decide if your company will acquire another company, introduce a new product line, focus on growth or cutting costs, open in a new country, or just keep things running exactly as they are. A good CEO should talk with the board, their employees, and occasionally outside consultants before making these decisions. As CEO, talking to these parties can alert you to risks that have been overlooked, or better opportunities to be pursued instead. As CEO, there are different ways to get this feedback. Some try to be as hands-on as possible. They will talk directly to customers, do their own sales calls, and work weekends at stores. Other CEOs decide what to do based on financial statements and the advice of senior managers that pass feedback up the corporate hierarchy. The first type of CEO normally gets more praise from being a hands-on manager that really knows their business, but both styles have pros and cons. CEOs that spend too much time performing low-level business operations can get too concerned with details. A hands-on CEO can only manage a company so large before their style of management becomes incompatible with getting the information they need to make good decisions. No matter what approach you choose to take, as CEO, you are still the only person that can decide the direction of the company. Are you going to rebrand to X.com? Are you going to remove a headphone jack from your flagship product? Are you going to pivot from selling books to selling everything? The average CEO does not make that many big decisions in a day. They often don't make that many big decisions in their entire career, but they do spend a lot of their time every day talking to people whose opinions they value, so when they do need to make decisions, they can make the best one possible. But making decisions that could change the course of an entire company's future is just the first thing that a CEO needs to do when they get to work, and the other three tasks don't get any easier. So it's time to learn how money works to find out what good CEOs actually do all day. The second thing that only a CEO can do is decide how the company's money is spent. A good CEO should take advice from their chief financial officer and other staff before making decisions like taking out a loan, issuing a dividend, or making a purchase. But ultimately, only the CEO possesses the authority to spend the company's money at their discretion. Since you have woken up to find yourself as the CEO of a very large company, it would be impossible for you to make every single transaction yourself. The largest transaction made by a company was $202 billion, which was paid by the British telecommunications company Vodafone to acquire Mannesmann in the year 2000.
That is a lot of money.
If you were the CEO of these companies, this deal would need your approval. But small transactions happen thousands of times in a day in companies because staff and suppliers need to be paid and basic expenses need to be covered. A good CEO will set up a framework for spending that lends their authority to use company money to staff in positions like payroll or to normal staff members through corporate cards to cover travel or general expenses. This framework should have levels of spending that need to be approved by different levels of management. If a junior analyst needs to book flights to attend a conference, they should be able to put that on a corporate card and get the expense approved by their manager. If the manager wants to reward that analyst with a $25,000 bonus, then they should require approval from their manager and possibly an independent payroll manager. Progressively bigger spends should need approval from progressively higher levels of management.
Probably the most significant announcement of the day is that we're excited to announce that we're going to be building a gigafactory in Mexico.
A good trick to cut down on expenses that you can use as a CEO is to rewrite the expenses framework to make it harder to get approvals for spending. If it's too difficult to spend money, staff won't do it unless it's really necessary. Saving money is good, but if your company misses out on opportunities because of it, it can reduce the returns you provide to shareholders. It's the shareholders who decide if you keep your job, so getting spending frameworks right is important. You want your staff to have everything they need to do their jobs, but not too much that they waste money on unnecessary shit. As a CEO, you can delegate making this expense framework to your CFO, but you still want to sit down with them on a regular basis to make sure that people at every level of the company aren't spending too much, but also aren't being stifled by financial bureaucracy. The next thing that only a CEO can do is act as the public face of a company. As the CEO of a large company, you need to accept that you are responsible for selling the company and its operations to the public because they are your customers and investors.
Get out there on the factory floor, get out there in the stores, talk to customers, think about what would you love to have.
Top CEOs spend a lot of their time talking to the press about how their company is going to deliver strong returns to shareholders. CEOs of big companies have communications teams that schedule interviews and prepare talking points. Whether they are delivering good news or downplaying bad news, a CEO's job is to convince anybody watching that their stock is undervalued and that the products their company offers are better than the competition. Making lots of media appearances is a great career move for a CEO for two reasons. The first reason is that it does influence markets. According to research from Oxford University's Svibe Business School, if a new CEO presents their strategy within their first 100 days, it has an overall positive impact on stock price. If the CEO keeps their investors happy, they keep their job. The second reason that new CEOs for large companies are often hired is because they are well known by the investing public because they have appeared in media before. High-level executives often hire their own personal public relations team to get them in articles and on news segments that talk about the work they are doing because they know it's the best way to land a C-suite job at a Fortune 500 company. If you are already a CEO of a large company, you get the same advantage as an incumbent president. Just by doing your job, you are getting attention. If a new board of directors at another company already knows of you and your track record, they will be more likely to draw up a competitive offer if you ever want to switch firms. The fourth thing that only a CEO can do is a less formal responsibility, but also their most important responsibility. They dictate how the business operates every day. That might sound the same as choosing a direction for the company, but it's focused internally on staff and systems.
It's not like, of course the CEO has to live the culture, has to, be able to make sure the leadership team lives those values. But if you can switch on every person, every employee's, every team member's own mindset to say, well, I'm not just working here, Microsoft's working for me, then you've achieved something.
Some CEOs like to encourage a relaxed atmosphere where people get good results because they feel comfortable and love coming to work. Other CEOs push professionalism at all costs and demand that their staff hold themselves to the highest standards no matter what they do or they will be let go. As a CEO, you will need to decide what kind of business environment you want to create. But before you choose, you need to know that certain approaches work better in some businesses than others. I used to work in investment banking, and the assumption was that you would show up on time in a suit every day and you would work late nights and weekends until your work was done. Anything less than that, and you were going to get the tap on the shoulder. The CEOs of hospitals expect the same level of professionalism out of their staff because people's lives are literally on the line. This approach wouldn't work as well in normal companies, though, because people in these professions only put up with these extreme expectations because they are compensated extremely well. Unless you want to pay all of your staff like investment bankers or doctors, a more relaxed corporate environment is a better play, or you will have high staff turnover. Big tech companies have done the opposite. They have relaxed dress codes, and they have built offices with free cafeterias and luxury amenities to get their staff to want to work extra hours instead of demanding it. Depending on what company you wake up as the CEO of, you will need to think very carefully about what environment will get the most out of your people. But once you know this, how do CEOs actually change corporate culture? They do it by leading by example. If you want your company to be filled with staff that show up on time, do their work, and go home, you need to do the same and make sure your leadership team does the same and make sure that they are demanding the same from their teams. If you want to create a culture of geniuses fixing the world's problems with technology, you should sit in the middle of the office at a desk visible by everyone working on code in your flip-flops. If you are going to demand 80 hours a week out of your junior analysts, you should be in the office 90 hours a week. Some CEOs try to order their staff into a certain style, but staff can see hypocrisy, and if there is hypocrisy at the very top, every single manager in the company is going to have to deal with questions like, why do we need to work late when the CEO leaves at 5 every day? Why do we need to wear a suit and tie when the CEO shows up in a t-shirt? As a CEO, you will learn that it's easy to think you can do whatever you want, and nobody will say anything about it because they won't. The CEO of a company does not directly report to anybody in the company. The only people that can fire you or take disciplinary action is the board of directors, and they do not watch what the CEO does all day, but your staff does. And it's your staff that make the company work well enough to secure you another year of a multi-million-dollar bonus. A report by the Harvard Business Review tracked 27 CEOs that ran companies with an average revenue of $13.1 billion. It followed them over 60,000 hours of total work, and it revealed that on average, they were working 62.5 hours per week. The study also found that 25% of their work is spent on people and relationships, 25% on functional and business unit reviews, 16% on organizations and culture, and 21% on strategy. 72% of their time was spent in meetings, and most of their communications, 61%, were handled in person. As a CEO, you are going to spend a lot of your time talking to your people, so setting the tone of the business may sound like wishy-washy HR bullshit, but it's probably the most important thing that you will do as a CEO.
There's never been actually data like this before. We've never known what CEOs actually do. And now we have some really rich data that we can dig into.
Fortune 500 CEOs consistently make headlines for making more money in a single year than most of us could hope to earn in our entire lives.
In 2020, the top 350 CEOs in the US made over $24 million on average. That means at my current salary, I'd have to work over, 281 years to make what they made in 1 year.
Tim Cook, the CEO of Apple, was awarded $853 million in total compensation for his work in 2021. Mr. Tim Apple wasn't even the biggest earner last year. Rivian CEO RJ Scaringe took home $2.3 billion in total compensation.
Good morning, Joe. Lots of comparisons now between Elon Musk and Rivian founder RJ Scaringe, but while Musk owns more than 20% of Tesla, RJ owns only about 1.7% of Rivian. Now, RJ is now a billionaire.
And the one and only Elon Musk was awarded more than $10 billion in Tesla options.
Stuff if you don't like it.
Suppose so.
Yeah, I mean, from the money that you sell all your stuff, you could buy new stuff.
Perhaps these two are a little more deserving, because they were the founders or very early personal investors in highly risky companies utilizing unproven technology. But most CEOs didn't take such personal risk, and many are still enjoying 9-figure salaries.
That is not my fault.
This isn't another video to complain about how unfair it is that the average Fortune 500 CEO is now earning more than 324 times the median employee at their company. We have all heard it before, and it doesn't look like it's going to change anytime soon, no matter how much the internet complains about it. Now would be a good time to remember the age-old anecdote. If you can't beat them, join them. Of the 500 CEOs on the Fortune magazine's list, only 21 were the founders or co-founders of the companies they lead. So if you want the abbreviated step-by-step guide, then step 1. Start a multi-billion-dollar company and don't get fired by the board or retire. Congratulations, you're now a Fortune 500 CEO. That was easy. By the time you have completed step 1 of this guide, you will probably already be a billionaire, so maybe the thought of a day job, however well compensated, might have lost its appeal. Anyway, 21 out of 500 is pretty bad odds, so let's go for the more involved but safer set of instructions. The remaining 479 chief executive officers got their jobs by working their way up through corporate roles, which starts with college. I know my video last week was all about thinking twice before committing to a college degree, but if you want the top job at one of these companies, a degree is mandatory. Every single non-founding CEO of a Fortune 500 company has a college degree. Out of the 21 founding CEOs, 16 of them have at least a bachelor's degree, and the remaining 5, like Mark Zuckerberg, dropped out of schools like Harvard because their businesses started taking off before they could finish their degree. I know the story of a high school dropout starting a successful company is popular, but the numbers don't lie. If you want to get to this level, you need to go to college.
Society has rules, and the first rule is you go to college. You want to have a happy and successful life? You go to college. If you want to be somebody, you go to college. If you want to fit in, you go to college.
You also need to go to a good college. Almost 10% of the list of non-founding CEOs went to just one particular school. That's right, DeVry University. Yeah, no, obviously it was Harvard. The other Ivy League schools are very well represented in this group of CEOs as well. Once you get into one of these schools, you need to pick what to study. 41% of Fortune 500 CEOs have an MBA, which is a Master's of Business Administration, so that's a solid pick. MBA programs focus on business structures, corporate governance, and the roles of executives in organizations, so it makes sense that this is the top pick. A lot of companies will actually make their senior executives complete an MBA part-time while working their regular hours. It's a grueling task on top of the regular commitments of a corporate executive, but sometimes the companies actually pay for their executives to get these degrees because of how valuable they can be. In addition to the lessons you learn about the general mechanics of running a company, the connections you can make at an Ivy League are worth the tuition costs themselves. So many powerful and influential people coming from these schools creates a self-fulfilling prophecy of more people coming from these schools because they spent their time there interacting with powerful and influential people. So if you want to be a Fortune 500 CEO, your best chance will come from getting into an Ivy League MBA program and networking like crazy while you're there.
If you hire an MBA from their program, and it's a very selective program, then you have a very high probability of hiring someone who's intrinsically intelligent and conscientious.
But an MBA is a master's degree. Master's degrees are postgraduate degrees, which means you need to get an undergraduate or bachelor's degree first. Picking the right degree straight out of high school might feel like a bit of a crapshoot, but Fortune 500 CEOs overwhelmingly favor one type of degree above the others. You might think this would be a business, finance, or economics degree, but you would be wrong. 97 of the 500 CEOs on this list studied engineering as an undergraduate. There is some selection bias to this. Engineering is a tough degree to get into, and unlike law or medicine, it does not have a narrow path of progression, but engineers are still a highly prized asset in the business world. Fortune 500 CEO engineers who were interviewed about their careers admitted that they chose to study engineering because it had the lowest unemployment rates and great options for career advancement. People that are thinking like that at the age of 18 are people that will go on to lead Fortune 500 companies, and people like that pick engineering.
We hire great engineers as fast as we can find them.
Engineers are trained to be good with numbers and complicated sets of information, but they are also trained to use their skills to complete projects while collaborating with other people with differing expertise. Engineers are also quite valuable to startups as early technical employees. The list of Fortune 500 companies is dominated by businesses that were once startups not very long ago, and early employees with the right skills are prime candidates for the top job once the founder steps down. The school you complete your bachelor's degree at is much less important than the school you get your MBA from. The most represented undergraduate school amongst the Fortune 500 CEOs was still Harvard, but only 3 of them went for their bachelor's degree, with the rest of the list spread out amongst more than 300 other schools. So just go to the best school you can and work on being near the top of your class, which will make step 2 a lot easier. The average age of a Fortune 500 CEO is 57, so don't worry. Once you have graduated from your engineering degree, you have plenty of time to work on your career to get yourself into a Harvard MBA. If you want to be the CEO of a big company, you have 2 options. Option 1 is to start working with promising startups. If you hitch your wagon to the next Google or Amazon, you will be a prime contender for the top job, and you would have likely picked up some stock options along the way. According to the New York Times, the average net worth of the first 2,200 Microsoft employees is over $10 million. So even if they never made CEO, they shouldn't ever need to work again. This strategy is very risky, because for every Microsoft, there are thousands of other businesses with 2,200 employees that don't grow at all, or even worse, end up going bankrupt. To increase your chances of making this strategy work, you should target a business with around 1,000 employees with good institutional backing from a private equity firm and operating in a field with a lot of room for growth. Tech, finance, healthcare, and direct-to-consumer are all good options. Once you land that first job, you gotta do the hard part, which is work like crazy, outlast the other employees, hope the company does well, and be in the right place at the right time when the founder steps back and needs a new CEO. If you want to take a more active approach at landing the top job, then you should start your career off in a more established company, preferably one with a good amount of business pedigree. Bulge bracket investment banks like Goldman and high-end management consulting firms like McKinsey should be your top pick. I'll explain why later, but the competition for graduate programs at these companies is fierce, so if you can't get in here, almost any big company will do. Your mission at this stage is to get to an executive level role as quickly as possible. Doing good work is critical to this, but it will only get you so far. You need to market yourself in every way that you can to become your own brand name in the industry. Social media, if used correctly, can be great for this. My good friend Richard over at The Plain Bagel works as an investment analyst, but he is well known outside of his firm because of his YouTube channel. Now, you don't have to take it that far, but putting yourself out there will mean that you can make it a lot easier for you to jump between jobs as you skip up the corporate ladder. Internal promotions are slow and difficult to get in most large companies. The average employee that switches employers every 2 years earns 50% more than the average employee that stays around for longer. If you do a good job of marketing yourself inside your industry, you are more likely to walk into a job interview where the recruiter already knows about you or something good you have done, which is a huge advantage over the regular schmuck with less than 500 connections on their LinkedIn profile. You can also fast-track this process. The reason working at a top investment bank or management consulting firm is a good place to start is because you can work 2 years at one of these institutions as an analyst and gain more experience than you would in a decade at a regular company. Recruiters know this, so the exit opportunities for bankers and consultants can be extremely good, and you can often score an executive level role before you are 30. The traditional route would be to go from an analyst to a team lead to a manager and then finally on to an executive, which will take a lot more time unless you get lucky with your job switching. A word of advice based on my own experience and no further research at all is that if you do want to go the investment banking or consulting route, you should avoid an exit into tech companies, even if you are an engineer by education. You should be able to land a good job with these outfits, but it will be difficult to move up because the culture of these businesses tend to look down with their soy lattes and on-tap kombucha on the old school business bros who totally don't even know how to hacky sack. A better plan is to get a job at a big company that is really boring. A boring company is going to have less young talent, which means you won't be competing against every other hotshot career-driven 30-year-old to get an executive position. Once you have worked yourself into a role where you are overseeing at least 200 other employees, it's time again to start thinking about that Harvard MBA. Personal branding is again going to play a big role in getting you into this highly coveted course. Harvard and other Ivy League schools like to brag about how many presidents, Supreme Court justices, and Fortune 500 CEOs went to their schools, and the best way for them to maintain those bragging rights is to only educate people who their admission office thinks is likely to go on to be a president, Supreme Court justice, or Fortune 500 CEO. If you can talk confidently and provide proof to an admissions officer about how you have reshaped your industry, you are a lot more likely to get in. You will also need to do the GMAT, which is a test to assess your business acumen. If you seriously want to be a Fortune 500 CEO, this is just one of many tests you would have taken in your career, so study hard and you should ace it. Once you have received your MBA from Harvard, life should be pretty good for you. The average salary of a Harvard MBA in their first year after graduation is $207,000, and that figure should be significantly higher if you go back into an industry where you already have executive experience. Your next goal is the C-suite, and to get there in a Fortune 500 company, you are going to need to double down on that personal branding. At this level, it is not unusual for individuals to hire the help of public relations consultants to arrange for them to give speeches and appear in media, so they are appealing to high-end recruiters, but also to company directors and shareholders who ultimately have the final say over who gets to be the chief executive. Top CEOs do earn a lot of money, and no, They don't work 320 times harder than the average worker, but they do have the potential to make or lose investors a lot more money than 320 regular employees ever could. Part of that is just branding. If an executive that the general public sees on the news every morning is announced as a new CEO of a company, it can boost the share price significantly. The other side of that is if somebody that nobody has ever heard of is announced, then it will raise a lot of questions about who is leading the company, even if that person is just as technically competent as a person with a PR team behind them. Even if you do absolutely everything right, you still probably have about a 1% chance at best at becoming the CEO of a Fortune 500 company. But that's okay. Even if you stray away from this exact path, you are still going to be making a lot of money and working in a very exciting role, but it will come at a huge personal cost. You have to decide if long hours for years on end are worth it for the chance to have your salary ridiculed by every congressman proposing a new tax bill. Because, oh yeah, that's right. If you do end up becoming the CEO of a public company, your income will become public record. So if you wouldn't feel comfortable putting up your paycheck on Facebook, maybe the job isn't for you after all. We enjoy the right to keep our personal finances private, which makes you wonder how we work out how rich the billionaires these CEOs will be working for actually are. If you want to find out the frankly scary strategies that journalists use to work out how much someone is worth to make their billionaires list, go and watch my video on why net worth lists are complete nonsense.